If you're a builder or remodeler taking deposits on projects, then listen close. Most builders think that a deposit is used to start the job and to show that the client's serious, but that's not what it's for at all. A deposit exists solely to protect you if the job stops or doesn't start at all. Even before day one, you've already committed to costs, materials purchased, trade deposits spent, and labor from your internal team. I had one builder show up on demo day only for the client to walk out in a robe and say, "Hey guys, I think we need to pause." So that's one version of it when the job never even gets off the ground. But the bigger risk is when you're halfway through. Then you really see what a deposit is for. It covers the materials you've already paid for, the trade work that's complete but that you haven't paid for yet, and your team's time that's coming due on payroll. So no, the deposit doesn't guarantee the project. It protects you from what's already been committed if the project goes south. So today we're talking all about construction deposits, how much to take, when to take them, and how to structure it properly so you're not the one left holding the bag. By the way, I'm Brian, and I was a professional remodeler and custom home builder for over 21 years. Everything I'm sharing with you right now is all from my 21 years of experience managing large-scale addition renovation projects and custom home builds. So let's get into it. The reason deposits matter so much is that they secure the risk on your projects. They're meant to protect you from the work that's already been set in motion. Every time you sign a contract, you're committing to costs, materials, trades, and your own team's time. Even before the first hammer swings, money's already moving. But here's where most builders and remodelers get burned because they use a deposit to float the upfront expenses. And when you do that across every project, you're now paying for Mary's job with Paul's deposit. And that means your safety net is gone. Because if a client pauses, cancels, or drags their progress payments, you're still on the hook for everything that you've committed to. The materials you've paid for, the trades waiting to be paid, and payroll coming due. One project can hurt, two can sink you. And that's how good builders and remodelers go broke. So don't treat the deposit as startup cash or working capital. Instead, treat it as protection. Because every time you use it to keep the wheels turning, you're erasing the very safety net it's supposed to be. So here are the top 3 mistakes that I see remodelers and custom home builders make with deposits. Number 1, thinking that the deposit guarantees the project. You think that once the check clears that the job is locked in, but it's not. Because projects stall, clients pause, and sometimes change their mind altogether. Like I mentioned a minute ago, I've seen homeowners cancel jobs the day the demo crew shows up. So no, that deposit does not guarantee the project. It protects you if the project falls apart or doesn't start at all. Number 2, treating the deposit like income. A deposit isn't money that you've earned yet, it's protection that you're holding. And if you spend it on day-to-day expenses, that protection is now gone. Then the project stalls and you're left paying for trade work that's already completed but not paid yet, materials that you've purchased, and your own team's time coming due on payroll. Number 3, not separating the deposit from your operating cash. When your money sits all in one account, it's impossible to see what's protected and what's available to be spent. So oftentimes you end up spending money that's not yours yet. And all it takes is one project going sideways to put all your other projects and potentially your business at risk. Because once the deposits are gone, so is your buffer. So if you don't want to make these mistakes, now let's review how you should structure your deposits. First, when to take the deposit. You take the deposit when the contract is signed, not when work begins, not when materials are ordered, or not when the client finally confirms the start date. Because like we've talked about, your exposure begins the moment that you commit. And I know it feels weird to take such a big check for something that you won't start for a while, but it's key at securing your risk. Second, how much to take. There's no universal number, but there are smart ranges. When deciding on a number, think about your potential exposure, often equal to your final couple of invoices. For larger projects, a 10% deposit typically offers enough protection. For example, if you're working on a $1 million project, a $100,000 deposit or 10% might seem like a very large amount. However, the last couple of invoices will likely total this amount. For smaller jobs where your upfront material and labor costs might be higher, you might want to consider taking somewhere in the neighborhood of 20 to 30%. And third, when do you credit it back? It's no secret that the hardest time to collect money from a client is at the end of the project. Tensions are high, budgets are stretched, and small details start to feel like leverage for your clients. But by holding the deposit until the end, you stay in control of that final payment. It takes away the client's ability to hold that money until punch list items and final details that you're already working on are completed. Okay, so you've collected the deposit. What happens next? There are 2 key concepts here: how to treat it from an accounting perspective and where to put it. From an accounting perspective, we always want to treat deposits as deferred revenue and not sales income. Here's why. Roughly 75% or 3/4 of that money is going to need to flow back into the project to pay for cost of goods, labor, materials, and trades. So in reality, that money isn't yours yet. So to reflect this properly, we don't enter this into our sales income account in QuickBooks. Instead, we hold it on the books as a liability on the balance sheet. And in plain English, we're just going to categorize it differently than a normal progress payment for a project. And I know you're a builder, not an accountant, and that's why every business needs a bookkeeper to be able to manage transactions like this. And this step matters because if you count it as regular revenue, then you're going to be inflating your profit and loss statement. In other words, you'll show more profit than you've actually earned. The second part is where to physically keep it. The best practice is to hold all of your client deposits in a separate bank account, separate from your operating cash. It's one place where you keep all of your client deposits together. You keep it visible but untouched until the end of the project. The key is simple. Keep deposits separate from your operating cash so they stay protected. And finally, how do you apply it? At the end of the project, credit the deposit back to the final invoice or last couple of invoices. This ensures you're protected right up to the finish line when client tension is at its highest and the risk of non-payment is real. A well-structured deposit keeps you protected from start to finish and protects your profit on every job. So now that you know how to structure a deposit, the most important piece we have to talk about is how to talk about them with your clients. Because this part can feel very awkward at first, but it doesn't have to be. After all, you're not asking them for a favor, you're just explaining a process, a way that you do business. The most important thing though is to not talk yourself out of taking a deposit because you feel like the client is nice and easy to work with or some other excuse that you tell yourself. Deposits and the way that you do them is part of how your business operates, no exceptions. So be consistent and confident. Here's how to say it. We take a deposit at contract signing to commit us to your project and place you in our production schedule. The deposit is held in a separate bank account and is untouched until the end of the project where we'll apply it to either your final invoice or last couple of invoices. We do this with every client to ensure that no one else's project will put your project at risk. Simple, direct, and professional. When you explain it this way, it doesn't sound defensive, it sounds responsible. Clients can see that it's not about trust. It's about running their project the same way that you run your business, with clarity, structure, and protection for everyone involved. So remember, a deposit is not about getting the project started. It's about protecting everything in motion once you do. Because once you sign that contract, you're committed to materials, trades, and your own team's time. And the deposit makes sure that those commitments never put you or your business at risk. It's what keeps one pause project from dragging down everything that you've built. And when you handle deposits with clarity and confidence, your clients will feel that stability as well. They see that you run their project like a real business and not a gamble. And that's the difference between hoping it'll work out and knowing that you're covered no matter what happens. So structure your deposits right, explain them clearly, and never treat them as an afterthought again. Because in this business, a well-structured deposit isn't a detail, it's your safety net. Alright guys, that's it for this video on why deposits matter in residential construction. If you found value from this video, go ahead and like and subscribe and share with someone else that needs to hear this message. Thanks for watching, we'll see you next time.